How to pick dividend growth stocks. What is up everyone, it's David here. In this video, I want to share my step-by-step guide on how to pick dividend growth stocks. So this video is going to be broken into two parts. The first part is the process. The second part is using that process, I'm going to show what a good dividend growth stock looks like and what a bad dividend growth stock looks like. Also, I finally finished moving into my new apartment, so I will give you a special behind the scenes look on how I'm making these videos for you. Now, as usual, it takes me a while to get ready, to brush my hair and wear the same t-shirt over and over again. So if you wouldn't mind gently smashing that like button, that would mean the world to me. Now without further ado, let's go. Now before we get started with the process of picking individual dividend growth stocks, it's important for me to define what kind of an investor I am, because that ultimately influences my decision-making process on choosing these individual dividend growth stocks. So in short, I am a long-term dividend growth investor, which means that I plan to own my investments for the next 20 to 30 years with the sole purpose of generating more dividend income every single year. And that also means that I don't sell very often. Unless the company no longer has a valid economic moat or have cut the dividends, then I might think about selling that stock. Now, if you want to know exactly why I chose to be a dividend growth investor, I'll leave a link in the description below, so feel free to check it out after this video. So in my process of picking individual dividend growth stocks, there's really just 3 steps. I'll list these 3 steps first, and then I'll talk about each of them independently. So there's filtering, which is essentially just shortlisting a pool of stocks to select from. And then there is the quantitative checks, which is starting to look into the numbers and what's under the hood. And then there's the qualitative checks, which is the economic moat, the future prospects of an industry, and if you're curious enough, the management team as well within the company. So when it comes to my own filtering process, it's pretty simple. So I start with industries that I'm personally comfortable with, and within that industry, I will filter for companies who have a dividend growth track record of greater than 5 years. If they have a growth track record of less than 5 years,
it's not worth your time, so you should move on anyway.
Now, if you're just starting out your investing journey, you can use Dividend Aristocrats as a way to help you get started with this filtering process. Now, Dividend Aristocrats is essentially a list of companies who have increased their dividends for over 25 years or more. And I've collated a full list for you in the description below if you're interested. Now, if you're past the Dividend Aristocrat stage, or you just want to invest in your own country like Australia, I use a tool called Simply Wall Street. They have a stock screener feature that allows you to filter stocks by country, market cap, and also different features of the stock. Now, they don't actually have a feature that allows you to filter for dividend growth greater than 5 years. But what I found is that if you filter for earnings greater than 5% and a dividend yield of greater than 2%, you tend to find companies who are consistently growing their dividends. I'm not sponsored by them, it's just one of the tools I use because it makes my life very, very easy. So once you have a short list of stocks to choose from, the next thing that I like to do is to start looking at their numbers. When it comes to their numbers, I usually like to look for 3 things. The first thing is earnings growth. The second thing is strength in balance sheet, and I'll explain that in just a second. And the third thing is debt to equity ratios. Now, when it comes to earnings growth, if their earnings aren't growing, your dividend check is not going to last long, because at the end of the day, dividends are paid out of earnings. So you want to make sure that there's a very healthy earnings growth anywhere between 5 to 15%. Now, on the point of strength in balance sheet, what you're really looking for is liquidity. Do they have enough short-term assets to cover their short-term liabilities? Better yet, can their short-term assets cover their long-term liabilities? And then the third thing is their debt to equity ratio. How much debt do they have compared to the amount of equity they have? And the final step is looking at qualitative factors for these dividend growth stocks. Now, when it comes to qualitative factors, I tend to look at what are their economic moats? What is the future prospect of the industry they're in? When it comes to their economic moat, I'm referring to what makes these companies so special. Do they have a competitive advantage? It'll be better if I show you a good dividend growth stock and a bad dividend growth stock, so you can see the contrast between the two. So let's start off with something positive and let's look at a good example. Good example will be PepsiCo. PepsiCo is in my stake dividend growth investing portfolio. Now, before we get started with the numbers and the filtering, they actually have a lot of brownie points with me because most of my favorite snacks like Doritos, Grain Waves, and Cheetos, PepsiCo's owned them. And at one point, PepsiCo even owned KFC. That's why you could never get Coca-Cola from KFC. So they have already earned a lot of brownie points with me. Now, PepsiCo is considered to be part of the consumer staples industry, which means that it's an essential good to the broader society. Pepsi has a very spectacular dividend growth track record. They've been growing their dividends for 47 years. Now, PepsiCo is currently paying out 76% of their earnings out to shareholders. Normally, I'd be quite concerned that a company is paying out so much of its earnings to shareholders, but in Pepsi's case, I'm really just not concerned at all. Because to be able to navigate multiple recession events and have never cut their dividends is an achievement on its own. And secondly, PepsiCo is a more mature company, so there are less growth opportunities for Pepsi compared to younger dividend growth stocks. But the third reason why I am definitely okay with that kind of payout ratio is their earnings growth. Over the last 5 years, PepsiCo have grown their earnings by 13.5%. And for a mature company, that is pretty damn incredible. So let's look a little deeper into their balance sheet and their debt to equity ratio. So Pepsi has approximately $24 billion worth of short-term assets and $22 billion worth of short-term liabilities. Just from a single glance, it doesn't seem like they'll have any issues in the short term to withstand the current public health crisis shock. But the interesting thing is their debt to equity ratio. So as you can see, they have $41 billion worth of debt and around $13 billion worth of equity. So that really means for every $3.15 of debt, there is $1 worth of equity. And let me tell you why I am absolutely okay that the debt to equity ratio is so high. Now, normally I like a dividend growth company a little bit more towards the safe side, where the debt to equity ratio is not above 1.2, which means that for every $1.20 worth of debt, there is $1 worth of equity. But in the current environment that we're in, because we're facing the public health crisis, the interest rate is at all-time low and it's expected to be very low for at least the next couple of years. So when it comes to Pepsi and Co borrowing a little bit more money to make sure that the company will sustain the competitive advantage over the long term and having a higher debt to equity ratio right now, I am absolutely okay with that. Now, when it comes to qualitative factors, I think Pepsi and Co have two main economic moats or competitive advantages, if you will. Now, the first one is cost advantage. At their scale, they'll be able to buy goods at such large quantities that they'll be able to get them for a significantly better price compared to a competitor who have to buy in smaller quantities. And because of that, they can actually sell the goods at a cheaper price or at least at the same price as some of their other competitors and get a better margin. The second economic moat for PepsiCo, in my humble opinion, are their intangible assets. Over multiple decades of being in the consumer staples business, they have built up some perennial brands that I just don't think will ever be able to replace in the future. Plus, I really think that packaged snacks is not gonna go away anytime soon. And I just cannot imagine a society or a supermarket that you walk in with no packaged snacks. If that's the future we're going into,
I don't know if I want to be part of that future.
Okay, now that we looked at a good dividend growth stock, let's look at a bad dividend growth stock and see what that looks like. It honestly didn't take me that long to find this one, but Xerox Holdings, in my opinion, is a bad dividend growth stock. Now, Xerox Holdings, if you're not familiar with them, you'll probably used their products before. So whenever you print out something, it's probably coming from a Xerox printer. So they're part of the information technology sector and they're mainly in printer services. So when it comes to their dividend growth history, it's been all over the place, to be honest. And they were paying out a lot of dividends during the 90s and then post-dot-com bubble, they've resetted the amount of dividends that they paid. And ever since then, they haven't really been that consistent when it comes to growing their dividends. They're still paying dividends, they're just not very consistent in growing their dividends. Now, when it comes to their payout ratio, it's around 65%. And again, similar to the Pepsi example, when you see a number that's above 60%, you want to dig a little deeper because that's quite high for a company that is not a REIT. Now, if you dig a little deeper into their balance sheet, you can see that their short-term assets well cover their short-term liabilities, and that's really not a problem at all. And even their long-term assets, they shouldn't really have a problem to withstand external shocks like the public health crisis. Same with their debt to equity ratio. It just seems like for every 76 cents of debt, there is $1 worth of equity. So very healthy balance sheets and quite healthy debt to equity ratios as well. But the problem with this stock is the negative earnings growth over the last 5 years. Over the last 5 years, Xerox have a negative earnings growth of minus 20%. And honestly, that's just not very sustainable to pay out 65% of your earnings and have a negative earnings growth over the last 5 years. So that dividend check is probably not gonna last very long. And I think this is further compounded by the fact that we have no idea how this public health crisis is gonna affect the culture of the workplace. Whether we would continuously rent out more office spaces or more people are going to work from home, Xerox make majority of their money from renting and maintaining photocopying machines in businesses. Imagine businesses no longer rent out offices. That's a very extreme point of view. If less business rent out office spaces, it means that Xerox have less of an opportunity to place machines inside those businesses and maintain them, which is where they make majority of the money. So that's problem number one when it comes to the future prospect of the industry. The second problem with the future prospect of this industry is that it's printing. And even though Xerox have said that they want to explore more of the future tech when it comes to 3D printing and trying to go back on the growth stage, I have just personally avoided this stock because of the inconsistent dividend growth history, the negative, especially the negative earnings growth, and I just don't think the future prospect for printing is very bright. However, on that note, future printing, especially 3D printing for medical applications, could be very ludicrous. But we'll see. We'll see how the industry pan out. But in the meantime, I'm more on the pessimistic side with a dividend growth stock like this. And that's essentially how I pick individual dividend growth stocks. It's nothing fancy. It might be a little bit time consuming, but I promise you it's not very difficult at all. Now, if you have any questions when it comes to my process of selecting dividend growth stocks, just ask the questions in the comment box below and I'll make sure I'll get back to you as quickly as possible. As promised, I wanted to give you a mini office tour just so that you can see how I'm making these videos for you. Okay, so I recently just finished moving in. So let's start off with this chair. I invested pretty heavily in this chair because I spent so much time in front of a computer and I did so much research in terms of what chair is best for, sitting in front of a computer for a long time. And of course, gaming chairs came up over and over again. And I spent about almost 500 Australian dollars on this. And it has some great back support. So I'd rather pay the money now instead of getting a massive medical bill down the track. It's been over a week, honestly, and really love it. So it's a great chair. So if you're interested, I'll leave a link in the description below. You can help yourself. This is essentially where I do majority of the work. I have a 2-point lighting system. There's a ring light, just a soft box. For better sound quality, I've invested in a mic. And if you hear my voiceovers, it just sounds so much better because I have a Rode mic on this, and even though it's a shotgun mic, the sound quality it's a little muffled from time to time. On that note, actually, I want to show you something. As of recording this video, we're currently on 1,886 subscribers, and it's been around 5 months since I've started this channel. So I really appreciate you guys watching my content. I really didn't think that people would like my videos in the first place. So I really do appreciate you dropping by, watching it all the way to the end, and gently smashing that like button because that would mean the world to me. And if this is your first time here, welcome. I really appreciate you dropping by my channel and also watching this video as well. This is my bigger monitor, and I use Notion as a way to make a lot of notes for my videos. And as you can see, it's quite extensive. Now, if you want to know more about how I research for these videos or how I make my videos, just let me know in the comments box below. Just say yes. And if there's enough people who want to see how I make these videos, I'll create a full video on how to make videos. And this part here is my otter, and I guess my otter brings a lot more joy to the video, so I'm always trying to keep him around somewhere. I still haven't figured out a name for him, and if you have any suggestions in terms of what we should name him, let me know in the comments box below as well. And this is my book collection. I read a lot. I have always been reading a lot. It's more of an interest to me. I have no idea why. Yeah, just tons and tons of books. If it's not books, then it's audiobooks. And this is a gift from one of my team members in the past when I worked at a startup. This means a lot to me. And this is the man in the arena quote. And ultimately, this quote is really all about, it's not really the critics that matters. It's the person who's working day in, day out, actually getting in the grind, getting their hands dirty. That's all that matters. It's the growth that matters. It's the work ethic. It doesn't really matter what other people think of you, and it doesn't really matter what critics say of you because they could have never done it and they're just speculating. So this keeps me motivated in a way, and I love this quote to death, and a team member has framed this up for me, so I appreciate that a lot. So now that is it for this video and a mini office tour. Thank you for watching this video all the way to the end. It really does help out my channel out a lot, and it means a lot to me that you stay all the way to the end because it tells me that you like content like this. If you enjoyed this video and you learned something new, just make sure you gently destroy that like button because that will help out my channel out a lot. Remember to subscribe, click onto the bell because when I release brand new videos, you'll be the first one to know. Oh, and also one more thing. If you want a free stock of Nike, GoPro, or Dropbox when you fund your account with Stake, I'll leave a link in the description below as well. I am not sponsored by the way. I just really like what they're doing and I use them myself, and I think you should try it too. And until next time, he's gonna do the honors, and see you soon.